Okay, welcome. Thank you for joining us this evening. We have a fantastic workshop with Professor Pete Kyle from University of Maryland. I'm Jung Seok Han, Associate Professor of Finance from Stockholm School of Economics and Swedish House of Finance. So it's a great pleasure to have Professor Pete Kyle and Claes Henrik Ulander from Penn Capital. So let me just introduce our speaker and panelist. We have a great panelist and speaker today. So Pete Kyle, Pete is a Charles Smith Chair Professor of Finance at the University of Maryland. He's author of one of the most cited paper in academia. And then price impact measure is known as Kyle Lambda after his name. And then he has many influential works, including high-frequency trading, informed trading, market manipulation, price volatility, informational contents of market prices, market liquidity, and contagion, and many topics. And we have Claes Henrik Ulander. He's a CEO of Penn Capital, chairman of the board at Erik Penser Bank and Star Stable Entertainment. In Penn Capital, he spent a lot of time developing and working with processes for the handling of large order flows on the global markets. So this is the plan today. We'll have Pete's seminar presentation about his work on continuous exchange. And after that, we'll have free discussion between Pete and then Claes Henrik, and we'll get also lively questions from the floor. Okay, so why don't you start with a presentation?
Okay. Thank you very much for inviting me here. So it's a pleasure to be back. And I'm going to be talking about my favorite topic, which I've been researching for my entire academic life, which spans too many decades for me to talk about. And it's most of my research, although I do have some empirical papers, this is meant to apply theory to real policy problems that relate to how markets work. The title of the paper the talk is based on is toward a fully continuous exchange. That paper is joint research with Jungmin Lee, who is a PhD student at the University of Maryland, and now she is an assistant professor at Washington University in St. Louis. A lot of people don't know where the University of Maryland is. They think of Maryland as one of those states on the East Coast, and they think of it as centered around Baltimore. When in fact my office at the university in College Park, Maryland is less than 10 miles from the White House. And so University of Maryland is really part of the Washington, D.C. area. And it's one of the, I think, the best university in the Washington, D.C. area. At any rate, the topic that this paper is about is called Stock Market Design Based on Flow Trading. So it's a policy proposal here, and we're proposing flow trading as a solution to the regulatory problem. And the regulatory problem has to do with what high-frequency traders do and whether there's a level playing field and how they make money, the topic of Michael Lewis's book that you might have read, Flash Boys. And so this is a kind of solution to the problems suggested in that paper, and the solution is motivated by theoretical research. And I'll describe some theoretical research that we've done that's very closely connected with our solution. So there have been some interesting trends in equity trading that have occurred over my lifetime. I used to work when I was a PhD student on the floor of the Chicago Board of Trade, and there it was a lot of traders in the pit screaming and yelling at each other. Apparently, I had this bright yellow jacket that I was supposed to wear. I wasn't a member, but I was writing up order tickets and talking to people on the phone. But since then, we've had big changes in technology, and the human traders have been displaced and largely replaced by electronic traders. And that has made it much easier to submit many small orders. You know, when I was checking orders by hand, 20 orders was a lot of orders to kind of go through and check. You had to make sure they were all accurate. But now you can check thousands of orders by computer, and the computer will probably get everything right. Another important trend since the 1980s is the way regulation works. In the 1980s, I think the exchanges and also the way the dealer markets worked helped keep in place the human traders, because it was a very profitable business for the human beings, and the human beings control the exchanges through memberships and so forth. But since then, that has also been replaced by changes in regulation. And so the combination of the two changes has been that exchanges have become much more competitive, but it's also become cheaper and easier to take big block trades and break them down into little pieces and execute the little pieces over time. So what you've seen is, instead of an institutional investor calling an upstairs dealer and saying, I want to trade 10,000 shares of some company's stock, nowadays they'll have an electronic interface, and they might submit 100 orders of 100 shares and execute the 100 shares over, let's say, an hour. And in the old days, it still might have taken an hour, because they may have had to call the dealer might have had to put the trade together, and all of the phone calls and talking might have taken some time. The result is that trading looks different today from what it's been. So one of the things I want to do is talk about what people thought back then, and now talk about how we think about it right now. We're proposing flow orders. We're proposing, there's some reason that traders like to take a big 10,000 share, let's say, we call it bet, and break it down into little pieces. We're going to look at the economics of that, and the economics of it suggests that, yes, that's what they want to do. They want to break big trades down into the smaller pieces as possible. And we're going to propose, let's just clear the market that way. Let's clear the market as if traders were continuously trading stock the way electricity is traded, or maybe the way water could potentially be traded as it comes out of the tap. You know, you're almost charged by the molecule for the water, even though the price is very small. Back in the 1970s, Fischer Black, the famous economist whose name is on the Black-Scholes model, he actually had lots of ideas about market microstructure, which is the topic finance professors call the topic I'm talking about today. And he had a vision of continuous trading that pretty much got implemented. And I'll talk about his vision a little bit later in this lecture. So I mentioned the regulatory trends that have made markets more competitive. We'd gone from the block trading model of the 1990s to some changes that were essentially forced on the markets by regulators. So in the 1990s, the SEC and the DOJ kind of went after NASDAQ in a kind of antitrust-like case. I actually worked for the DOJ on that case, but the result was changes in order handling rules that made it harder for dealers to disintermediate customers who wanted to trade directly with other customers and not actually be trading with a NASDAQ market maker. So they changed the order handling rules to make it easier for customers to place orders that other customers could trade against. And at the same time, or approximately the same time, they started changing the tick size. It used to be that stock market trades in the United States were made in increments of $0.125 of a dollar, so that would be 12.5 cents was the minimum price fluctuation for a stock. So on a typical stock priced at, say, $50, 12.5 cents is 25 basis points. So it's a fairly large cost right there. It was reduced from 1/8 to 1/16 of a dollar, and then of course now it's in cents. So that a 1 cent move on a $50 stock is 2 basis points and not a much larger number. Then you had the regulation NMS in the United States, and you have MiFID here in Europe, and the result of that has been that the exchanges compete more directly against one another, and that's taken away a lot of their power to charge high commissions. So you have the result of these competing exchanges with the human beings displaced by electronic limit order books, and then the electronic exchanges compete with one another. Okay, so we think these are driven by technology. It makes it very easy to place small orders, and you've had this evolution of order handling systems that actually place the small orders and execute them pretty efficiently. Okay, I want to talk about finance theory. So what does finance theory say about all this? My perspective on this goes back a long time. But I want to talk about a recent paper that I've written with Anna Obazhayeva and Yajun Wang. Anna Obazhayeva used to be an assistant professor at the University of Maryland. She got her PhD at MIT, and Olga, her sister, is actually an assistant professor here and sitting in the audience, who, after getting her PhD at LSE. And Yajun Wang was also an assistant professor at the University of Maryland after getting her PhD at Washington University in St. Louis. At any rate, we have written a paper that essentially applies game theory to the game of trading stocks. There are lots of papers that apply game theory to the trading of stocks, but I think our paper, compared to a lot of the other ones, has got a fairly realistic feel to it when you think about the markets of this century. Whereas some other papers, including my own paper that Jung-Suk mentioned, it was a paper that was kind of designed to explain what was going on in the 1980s when it was written. And I thought it did a pretty good job of describing what's going on in the 1980s. So what are we doing? We're thinking of the players in the game as, you can think of them as asset management companies. We call them traders, but think of them as big traders. And these big traders are big enough that they have market power. What does this mean? It means they worry about price impact. So a big trader who has market power is not going to incur gigantic market impact costs if they can avoid it by trading in a manner that would reduce price impact. So the model assumes imperfect competition. The model also assumes that the traders are constantly acquiring new information, and they want to trade on this information. Now, there's a big puzzle that's been going on in finance for decades, which is to explain why there's so much trading volume in speculative markets. We don't have an answer for that in this paper, but there are a lot of different kind of theoretical devices, or maybe we could call them behavioral explanations for why so much trading takes place. Our behavioral explanation or theoretical device is what we call overconfidence, and you could even call it relative overconfidence. And the idea here is that the asset management companies, or perhaps more realistically, their customers, think that each customer thinks that his asset management company is smarter and better than the other asset management companies out there. And so every asset management company thinks that it can make money trading against the other asset management companies. So we don't make a distinction between the customers and the companies, so we just assume that the companies themselves, or the traders themselves, believe that they have information and a model that allows them to make money at the expense of other traders. Well, it turns out that if you assume a kind of symmetry in the equilibrium, that is, you assume that the asset management companies are all about the same size. It's almost like assuming a poker game in which everybody starts out with the same stakes on the table. You can model, and let's assume they're willing to play poker because they think they're smarter than the other guys at the table. Then you have a very good analogy for the game theoretic setup in this model. Traders are willing to play. They all think they're better than the other guy, but we're going to act as if each of them, in fact, is equally skillful. And so the question then is, what does the solution to this game look like? I was reading in the newspaper about, they've got artificial intelligence has been looking at how to play poker, and they now have pretty good algorithms for how to play poker, and these electronic algorithms play poker pretty much like a human being would play poker, with bluffing and unpredictability, and they play in a way it's very hard to forecast what they're going to do next, and they can beat human beings as well. Well, it turns out this game that we model, it's actually complicated to kind of try to read through the paper and understand the solution, because there are hundreds of equations that you have to kind of plow through to understand it. But the intuition behind the solution is very easy to explain. And the solution itself is essentially a closed-form solution that you can describe very easily. So I'll describe it, and then I'll kind of make the claim that this game is pretty realistic, and therefore markets should be mimicking the way this game works. So what happens? Well, each trader realizes that he's getting his own information, but the other traders are getting information too. And as the other traders trade on that information, some of that information is incorporated into price. So when the traders look at the price, they're learning essentially what the other trader's information is. but they think their information's better. And so they're going to still trade because everybody thinks his own information, own private information is better than the other person's information, even though it's all incorporated into price. But when you trade, you move the price. You have price impact. The price impact is a kind of drag on your performance that you think you're going to get beating these other people trading. And so in the model, the traders recognize this, and they need to trade in such a way as to kind of reduce the effect of the price impact, of the tendency for price impact to reduce their profits. And so how do they do it? Well, instead of dumping 100,000 shares or 10,000 shares on the market and executing it in 1 minute, what they do if they want to trade 100,000 shares is they trickle the shares into the market, and we assume they do it continuously. They trade the shares as a flow. Maybe they trade 10 shares per second or 1 share per second. If they trade 1 share per second as a flow, then after 3 hours, that's about 10,000 seconds, they will have executed their order, and they will have done it in a way that actually has very small amount of price impact. So then you ask, well, how fast do these, what actually determines whether it's 1 share per second or 10 shares per second or 100 shares per second? And the answer there is it, of course, depends on how much of an effect trading 1 share per second has on the price. But it also depends on the inventory they would like to own. That is, we call it the target inventory, but it's the quantity that if they could buy it instantly without price impact, it's that quantity. And they can't buy that quantity instantly with price impact, but they gradually move in the direction of that, what we call target inventory. And it depends. So it depends on the capacity of their asset management company. We call that risk aversion, or we proxy it with risk aversion. It depends on the price impact. And then thirdly, it depends on how fast they think their information is going to decay. So they have these private signals. And they're private. If my private signal says one thing and you disagree with me about how to interpret that signal, I'll place a bet based on that private signal. But eventually, you're going to get some information that you actually believe that displaces my private signal. In other words, you'll learn what my private signal really kind of was, or at least you'll learn the truth. And as you learn the truth, our disagreement or our different expectations tend to be not so different anymore and would tend to converge based on differences that we've had in the past. Of course, we're all constantly collecting new information, and our differences are increasing again based on the new information. So what happens is that over time, the traders are buying based on their private signal, but other people are kind of figuring out or learning what that private signal was about, and that reduces your need to trade. But the speed with which you trade depends on how long it takes them to learn about your private signal. So the result is traders smooth their trading out gradually over time, trading off what we call the decay of the information against the permanent and temporary price impact. Okay, so the one thing I haven't talked about yet is permanent and temporary price impact. So in the paper I wrote in the 1980s to describe what I thought was going on in the 1980s, you have what's called permanent price impact. And that is a trader with private information goes into the market and buys his 10,000 shares. That might move the price up by 25 cents, let's say. As long as he holds the 10,000 shares, that 25% price increase that he caused kind of stays there. Other things will be moving the price as well, but the price will be 25 cents higher than it otherwise would have been simply because he's holding the 10,000 shares in inventory. And then if he dumps the 10,000 shares at some point in the future, the price will go down 25 cents. So he has price impact, he has to worry about it, but it's what we call permanent price impact. It turns out in the equilibrium of this model, price impact is endogenously generated by the complicated mathematical equations, but the price impact that's generated is what we call temporary price impact. And what temporary price impact means that if you buy 10,000 shares per day at a smooth rate throughout the day, you might make the price 25 cents higher during the day that you're buying the shares. And then if you stop buying the next day, the price will drop down 25 cents and be what it was kind of before you started buying. So the next day, you have another opportunity to buy 100,000 shares. And so you'll gradually buy 100,000 shares the next day, keeping the price 25 cents higher the next day too. And the result is that the price kind of stays 25 cents higher over time, but only because you are continuing to buy steadily day after day after day, keeping the price higher. So we call that temporary price impact. And I think it's pretty obvious that that temporary price impact is important, and also that it's the that it describes the way traders actually trade. The extreme example is if you look at Warren Buffett, he'll often go buy 5% of the shares in a company, but he doesn't buy them typically. Sometimes he might buy them in a block trade with someone, but a lot of times he just goes into the market and very quietly, over a long period of time, maybe a whole year, accumulates a big position in a company in very, very, very tiny pieces. Okay, so that's what's going on in this model. Traders rationally take into account their price impact. They understand how price impact affects trading opportunities in the future. They could bluff, they could try to bluff, they could try to front run, they could try to spoof, and all these kind of things that the regulators don't like. But in equilibrium, it turns out in this model, they don't really do that. In equilibrium, the way they exercise market power is they exercise market power by trading gradually, by not trading aggressively. If they deviate from that, and for example, trade extremely aggressively, even though it's very costly, and what they will do is cause a flash crash. And I think that what happened in what we call the flash crash in the United States, that occurred in May of 2010, was it? One big trader went into the market and sold more than $4 billion worth of stock index futures contracts over like a 15-minute or so period. And during the period they were doing that selling, prices declined like 5% more than they had already gone down, or even more than 5% more than they had gone down that day. And prices stayed down even as they continued. The prices declined, and then prices started kind of rebounding. And a lot of the selling was occurring kind of as the price was rebounding. And many people view that as being kind of inconsistent with models of price impact. In particular, it's inconsistent with the model I wrote about in the 1980s. But it's actually very consistent with this equilibrium. This equilibrium says that when traders start selling, the price immediately falls. And then as they sell, the price doesn't fall anymore. They've already put 500 basis points of price pressure on the market, and they're holding the market down by continuing to sell. So continued selling doesn't make the price go down further. It just keeps the price down until you stop. And then when you stop, the price starts coming back. Okay, so I think that looks like, I don't know what the motivation of the particular trader was that caused the flash crash, but it looks to me like suboptimal rapid selling causing a flash crash. Okay, so when we think about this sort of game theoretic model, I think it looks as a very compelling story of what asset management companies actually do. Because what goes on in the model is the traders are collecting some random information that's arriving. They're sort of filtering it mathematically, which means they're converting it into a signal. They're then using the signal essentially by doing what a trader today would be doing, a linear regression in a computer. But they're converting that signal into a prediction of what stock prices are going to do in the future. They're also using the past history of prices in that predictive model as another signal to forecast what stock prices are going to do in the future. And then they're calculating an optimal portfolio they would like to hold. And then they have an order execution algorithm and a kind of portfolio model that tells them how fast they should be selling in the market, taking into account market impact. So they have a kind of a market impact model. Well, that's what's going on in the story of the equilibrium, but that's actually what happens in real asset management companies, I think. The ones that I'm familiar with operate very much like that. They trade gradually towards a target inventory over a long period of time. Okay, so that's the game theory behind all this. Our proposal is to say, look, this is the way traders want to trade with one another. It's kind of the way markets should work. There was a lot written in past decades about what a perfectly competitive market would look like, as if that were a kind of feasible objective to try to achieve. We don't think that stock market's naturally competitive. We think the big traders are naturally big and they have market power. And when they do have market power, you get an equilibrium like our theoretical model. And if that's the equilibrium you get, what's going to happen is that traders are going to try to implement that equilibrium even if the institutional structure doesn't match the equilibrium perfectly. And so our proposal is to say, why don't we tweak the institutions to try to match this theoretical equilibrium and make life easier for everybody. And so what we want to do is implement a market design. There's an area of economics called market design that looks at how to operate markets given the peculiar characteristics that make every market different from every other market. So there are markets for like, say, human kidneys, or markets for oranges or apples. My father was in the market for bales of cotton. And so all markets have their own characteristics, and those characteristics make things different. Here, one of the characteristics is that shares of stock are essentially infinitely divisible. They're not like Leonardo da Vinci paintings that come in discrete units and are all different. They're infinitely divisible, and they're homogeneous. And there's nothing really about them that makes you not want to be trading them in little pieces over time. So these characteristics of equity trading allow us to try to structure the market to achieve what other traders seem to want to achieve. Okay, it turns out that our proposal is very closely related to this debate that has been going on for several years about high-frequency trading. What do high-frequency traders do, and is it a socially useful function? Well, we think it's kind of difficult to answer the question of whether it's a socially useful function, because historically the technology has kind of been tilted in such a way that the high-frequency traders have kind of an advantage that other traders don't have. And so if high-frequency traders are profitable, it's hard to jump from the idea that they're profitable to the idea that they're performing a valuable service. Maybe they're simply profitable because they have better technology than other people, and that allows them to kind of make a profit at other people's expense without performing any useful service. So in that sense, our paper is addressing the same question that Michael Lewis was addressing in the Flash Boys book. And it's also the same question that Budish, Crampton, and Shim were looking at in a paper on frequent batch auctions. So they have a proposal that's closely related to the proposal that we have. And we actually are talking to them quite a bit about doing research together on this. So I wouldn't call it a totally incompatible proposal, but it's kind of it's a proposal with a different motivation. They call their proposal frequent batch auctions. Their intuition is kind of the opposite from ours in one sense, and it's kind of the same in another sense. The way in which it's the same is that you just embrace the idea that traders aren't going to do gigantic block trades all at once. They're going to break their trades up or break their big bets up into little pieces and execute them gradually over time. But their intuition is that you want to do it as kind of relatively infrequent, discrete chunks. And they think that by doing it that way, you can kind of disintermediate the high-frequency traders to the extent that the intermediation of the high-frequency traders is only based on the fact that they're faster than other people. If high-frequency traders are better at risk-bearing or have valuable information that allows them to perform some valuable intermediation service, fine, they'll survive and they'll be profitable doing that service. But they won't be able to survive, according to Budish, Crampton, and Shim, simply based on being faster than other people. And it turns out that our proposal actually implements that objective. We think their proposal doesn't quite implement it the way they think, but we think our proposal implements it quite well. And the basic idea, let me see if I've got some slides about this. I've got some other slides here about the costs and benefits of high-frequency traders. So let me motivate this a little bit, and then I'll go back and talk about how our proposal eliminates it. So how do high-frequency traders make money? We think there are a couple of ways that high-frequency traders make money that are kind of based on their speed. And one way is by picking off slower traders. So if a trader has an order sitting in the market and something happens, let's say I've got a big buy order sitting there in the market and something happens, it means that the price of the stock is going to fall. You can, I'll want to cancel that order, of course, before it gets hit. but I might be late, and someone might hit my order, and I find that it's executed even though I wished I had canceled it. We refer to that as being picked off. And the high-frequency trader who can hit my order very quickly because they get the information a split second, maybe a few milliseconds before I do, they will have made that profit by picking off stale limit orders. So that's one way a high-frequency trader can make money. Another way a high-frequency trader can make money is to simply follow the rules, but take advantage of the rules of most limit order books that have time and price priority. So remember, price priority means that if your price is better than someone else's, your order gets executed first. A higher bid price gets executed before a lower bid price. A lower offer price gets executed before a higher offered price. So that's price priority. Time priority says that if you have two orders that are at the same price, the tiebreaker is that the earlier order, the one that's been sitting in the limit order book the longest, gets executed first. So what does that mean? That means that if a new price level is suddenly established, and I'm a high-frequency trader, I might want to, and I know there are going to be a lot of bids, let's say, at this new price level. I want to be the first bid in the book. If I'm the first bid in the book and I have other bidders behind me, then if a small order comes in, it will execute against my oldest order. And I'll have what the traders in Chicago used to call the edge on the trade. And they can sit there holding that inventory, that small inventory, looking at the queue of people that used to be behind them in the book. And as long as there's still people there, if they decide they don't like that trade, they can just turn around and hit somebody who was behind them in that time priority queue. And so they'll break even. That's kind of their downside. But the upside is that the price might move in their direction. And if it does, they'll make a profit on the trade. So having the time priority in the limit order book gives you not a free option, but it gives you a kind of option value that enables you to limit your losses by hitting people behind you on sometimes, but to capture the gains if prices move in your direction. If you're a high-frequency trader, you probably get time priority more than other people do by jumping into the book very quickly. Okay, so these two ways of making profits we think are ways that high-frequency traders make profits simply because of their speed. There are other ways they make profits. Maybe they have better signals that they generate by pooling together information from lots of different markets, or maybe they have predictions about what prices are going to do in the future, or maybe the rest of the market is in a hurry and is willing to suffer some temporary price impact, and high-frequency traders then compete to minimize that price impact. Those are good services provided by high-frequency traders, and I don't want to disparage them. And so what our proposal is going to do, it's going to take away the advantages the high-frequency traders have in being able to pick off slow traders or obtain time priority in the book. It's going to leave, but it's going to still leave them with the opportunity to make a profit by bearing risk or by having better information than other people have. Okay, so how does it do that? Well, when I was first starting to, I'm going to skip this slide and talk about this one in a minute. But when I was first starting to trade, the guy that was kind of teaching me about trading was saying, you don't leave a resting order sitting in the market. So which is to say, when you leave size, a big bid or a big offer, sitting there in the market, it's just an option for other traders to pick it off. And so one way to be a good trader is just not leave a lot of size in the market. And so if you want to trade a lot of size, trade it in lots of little pieces over time. And then if something happens and one of your orders gets picked off, it's just a tiny little piece of an order that gets picked off, and so your losses are very small. And so essentially what our proposal does is it says, let's take this intuition of not leaving any size in the market all the way to the limit so that nobody's ever leaving any size in the market. Everyone's trading as a flow. You're trading, let's say, 1 share per second. So if someone gets some information a millisecond before you do and come into the market and try to pick you off, they will be able to trade 1/1000th of a share with you. And so they'll make some tiny little fraction of a penny at your expense, very negligible amount that we think is essentially zero, as long as these time lags are really small. So let me go into our discussion of this, but the intuition can be summarized very simply. Today's markets, even though we call them continuous limit order books, they have a lot of discreteness. And in particular, the orders come with a minimum lot size, and also prices come with a minimum tick size. And then there's some latencies built into the system that maybe make it impossible for time to be perfectly continuous. Of course, we're not going to make the latencies go away completely, but what we're going to do is we're going to try to let quantities be much more continuous functions of prices by letting prices themselves be very continuous. And so we'll take the discreteness in today's market. This is an upside down picture. The economists will think I'm butchering economics, because normally in economics you put price on the vertical axis and quantity on the horizontal axis. I've done it the reverse here. So these are kind of what you would call inverse demand schedules. Either way, it's the same underlying economics. And the dots here, the red dots represent sell orders, buy orders, and the blue dots represent sell orders. And the dots themselves represent the fact that the quantities need to be discrete. And then you can see that the dots lie on these vertical lines, and these vertical lines are separated by 1 penny increments. And so you're not allowed to put a dot between the vertical lines if you're not allowed to trade in sub-pennies. And so this captures the way current markets work, where you have discreteness in both quantities and prices. And then, of course, what happens is that traders submit orders, and all the buy orders that are submitted represent a kind of demand schedule. All the sell orders that are submitted represent a kind of supply schedule. Because of this discreteness, they look like what mathematicians call step functions, even though they're not exactly functions, but you can see the stair steps there in the picture. And then if there are any buy orders that are at prices equal to or higher than the sell orders, they will get matched together. And the way I've got them matching there are 8 sell orders and only 5 buy orders at the price that matches. So 3 of those sellers don't get their sales executed. And I'm presuming that the ones that do get executed might be the high-frequency traders, because they were fast and got there first. And they're the oldest ones in the limit order book. And the ones at the end of the queue might be the ones that are not the high-frequency traders, and they missed out on their trade. So that's a picture of kind of the way trading works today. Each dot might be 100 shares, and the prices are on this discrete grid of 1 penny increments. Okay, I'm going to skip all this. I'm going to skip all this, and I'm going to go directly to a picture. Let's see. I guess I need to describe this equation first, but you don't need to pay too much attention to the equation. Let me just describe the way our proposal works. So if you're a trader, you might be familiar with the concept of a scaled limit order. So if I wanted to buy, let's say, 1,000 shares of stock, I might submit 100 shares at $49 and another 100 shares at $49.01, another 100 shares at $49.02, and have a stair step of orders that go in at different prices that are all connected. And what am I doing there? I'm trying to approximate a straight line linear function, but I'm doing it with this discrete grid that looks like stair steps. So what we're proposing is what we call continuous scaled limit orders. And what this allows you to do is to submit a lower bound price, which we call, there's a typo here, one of these is supposed to be pH. No, excuse me, it's right, it's fine. A continuous scaled limit order where there's a maximum rate at which you want to buy on that order. That maximum rate might be 1 share per second or 10 shares per second, something like that. But you don't always buy at 10 shares per second. If it's a buy order and if the price is below, let's say it's a sell order. So the buy order. Let's see. If it's a buy order and the price is below the lower limit on your scaled limit order, then the price is too low and it's not favorable and you don't buy anything. So, excuse me, if the price is below the lower limit on your order, it's a really favorable price, and you will want to buy as rapidly as possible, and so you'll buy at rate Qmax, maybe 2 shares per second. On the other hand, if the price is higher than your highest limit price, well, now the market is way too high, it's way too expensive, you don't want to buy at all, so the quantity you buy is 0. And if the price is between these 2 limits, and these 2 limits might be separated by $1, or they might be separated by 10 cents, or they might even be separated by 1 cent, and you're trading in between, But if the price is between the lower limit and the upper limit, then you trade at some rate that's between 0 and your maximum trade rate of, say, two shares per second. And you'll linearly interpolate that function. So if it's halfway in between, you'll trade 1 share per second. If it's a quarter of the way in between, you'll trade maybe a half a share per second. Okay, so the idea is to place a demand schedule that is not a demand schedule for these discrete quantities of 100 shares, but is a demand for a flow of shares, 2 shares per second maximum. But the flow could be 0, it could be 2, it could be anything in between. And what it is in between is based on what the price actually is. Well, all this is, if you've taken an introductory economics course, this is just a demand schedule in Economics 101. In fact, when I took economics, the professors made a big distinction between stocks and flows. And they pointed out that a lot of the goods that we talk about really are flows. Consumption is the flow. And when you measure the amount of food people eat, you typically measure in maybe calories per day or something like that. That's also a flow. So we're just taking a standard way of thinking about a demand schedule and applying it to stock trading. Okay, so what does our proposal do? It makes things continuous. The first thing it does is it makes the quantity that you trade a continuous function of the price. You could trade 0 shares per second, 2 shares per second, 1 share per second, a half a share per second, a tenth of a share per second, a hundredth of a share per second, depending on what the price is. And it'll adjust essentially continuously. And what does that do for you? Well, we also require that the demand schedules be downward sloping. That essentially guarantees that at every point in time, there is always a price that represents the intersection of supply and demand. And as long as there's some people that want to pay a bit more than that, and people are willing to take a bit less than that for their selling, there will be trading volume. And the trading volume will be measured as like 20 shares per second would be the market volume. And so it kind of guarantees a unique equilibrium price, and it guarantees that trading literally is taking place continuously, not like it used to take place at the Chicago Board of Trade where they had a gigantic tick size. The minimum price fluctuation was really huge, and so you would sit there and nothing would happen for 5 minutes, and then thousands of contracts would suddenly trade in a kind of very discontinuous way at these price points that were on a discrete grid. And the other thing that our proposal does is it makes the quantities a continuous function of the price, but it also makes the quantities a continuous function of time. So if your order is executed for a fraction of a second, you only trade a fraction of that. 2 shares per second. So, and what does it mean when trading is taking place continuously like this at a unique equilibrium price? It means there's nobody ever standing in line who wants to trade at that price, but can't trade as much as their orders that their orders say that they want to trade at. So there's never any issue of time priority. All of the demand is satisfied. Both buying and selling is satisfied at the market clearing price at every instant of time. So this means that the high frequency traders will not be able to make money by having time priority. Whoops. Let's see. I lost my track here. I've got a long discussion, so here we are. So they have to compete on price. So the second thing, and I may skip over the slide that talks about this, so we basically eliminate the ability of high-frequency traders to make money off of time priority. The second thing we do is we make it very difficult for high-frequency traders to make money picking off resting orders in the limit order book. I think I referred to that earlier when I said that at any point in time, you're only trading 2 shares per second. So if a high-frequency trader gets some information a millisecond before you get it, they trade with you, but they only trade 2 1,000ths of a share, 2 millishares. And so that also takes away the ability of high-frequency traders to make money by getting information slightly before other people. Okay, so let me skip ahead and quickly finish up these slides. Well, what about liquidity provision? Well, if high-frequency traders are providing liquidity, that is, they're holding inventories that other people don't want to hold, then they should get an economic compensation for that. There's nothing in our proposal that prevents them from getting that economic compensation. While it takes away the ability of high-frequency traders to pick off other orders, and it takes away their ability to exploit time priority, it doesn't take away their ability to provide an intermediation service that other people are willing to pay for by letting high-frequency traders hold inventories that they don't want to trade. Another issue that arises is message costs. The more automated you are, essentially the lower your message costs are, and the easier it is for you to handle like a large volume of transactions. You know, I always think it's quite a bit of trouble for my wife and me to go through an invoice that we get from Amazon or something. It takes us a while to check all the details, make sure we got the right quantities, we get our groceries, sometimes online. It's not that much trouble for the company itself to do the checking because the company's checking everything in a computer. They've got huge economies of scale. And so the bigger the economies of scale are, the lower the per unit cost for you of checking messages. And I think that another advantage high-frequency traders have is an economy of scale in checking messages. But what does our proposal do? What our proposal does is by allowing traders to submit these continuous scaled limit orders, it allows a trader to submit one message. And that message is, it could be a VWAP order. The easy way to submit a VWAP order is you just submit one of our continuous scaled limit orders and submit it so that it's executable. That is, if you want to buy, you just make sure the lower and the higher prices on the order are kind of high enough that it'll probably be fully executed. And if you do that, you just kind of submit one order, and that order will execute perhaps all day. And you will get an executed price that's actually something that would be better called TWAP. You'll be buying so many shares per second, but it's a very close substitute for VWAP, volume weighted average price. You'll be participating in the purchasing continuously at the price that you see in the market. A lot of traders like to do that. Yes?
What kind of market depth or time/depth information would you have for the traders to enter the orders? I mean, what would they see of the market?
What would you be looking at? Yeah. If you're looking at a screen, you won't have any depth, right?
No, but you have some kind of time or...
Right, so what you'll have is you'll have a kind of...
the way shares can I turn over in the coming seconds?
Right, so what you would have is a measure of like the volume that is taking place now, and that the market would be, and the market clearing price that is taking place now. And then there would be an indication of like how many more shares per second would it take to push prices up to maybe the next penny increment, and then how many shares would it take to push prices down on a per second basis, shares per second basis to the next penny increment. So you would have depth over time, but you wouldn't have no instantaneous depth. If you wanted to trade 1,000 shares in 1 millisecond, you would have some enormous price impact. Your price impact might be several dollars. So it would not be practical to trade thousands of shares in 1 second, but it would be practical to trade thousands of shares over a period of time, 15 minutes, an hour, or so forth.
But you would have some sense of impact for the 1,000 shares over the coming
Yes. You'd have pretty good information from the market. They could give you as much information as they wanted to about the shape of the limit order book. We actually don't favor giving a lot of information, but I had the picture back here. Hopefully, I think I'm going in the wrong direction. I lost track of where I'm on my slides. I had this picture, and they could give you a kind of complete picture of both the supply schedule and the demand schedule, and you could infer from that there's this much excess demand in shares per second, and therefore if you submitted an order of a certain size to buy or sell so many shares per second, here's what the kind of the effect that would be on the market clearing price. So there's nothing to prevent the exchanges from being very transparent in that way. But we kind of don't favor a lot of transparency. We certainly favor revealing the quantity and the price that are clearing the market now. And we favor revealing information about what the slope is right here at the intersection of supply and demand. But we don't favor giving a lot of information about what's way away from the market clearing price. And indeed, there have been some scandals in the market that have occurred, I think, because that information is not very informative, but then people will place orders away from the market to try to influence what other people are thinking. That's part of the gaming in the market. The regulators don't like that gaming because the regulators don't like to think of markets as a game, even though market trading is a game. But that's another paper that I don't have time to talk about here. Okay, so Fischer Black in 1971 predicted that when trading became computerized, the market would look kind of like what we're talking about here, that bid-ask spreads would become very small. We essentially have driven the bid-ask spread to zero, but it's a bid-ask spread of zero for infinitesimally small quantities. And that's kind of what Fischer Black said would happen. He also said that liquidity would not be supplied cheaply, instead it would be supplied over time. And that's also what we've seen. And that customers would spread their large trades out over time to reduce trading costs. So he was, we think very prescient, and our theoretical model suggests that he was right. But he didn't foresee high-frequency trading. And he didn't foresee that the bid-ask spreads maybe wouldn't disappear completely. He maybe didn't foresee that retail traders might actually still incur some costs. Because I don't think he foresaw this technology gap that high-frequency traders maybe have, and didn't foresee how time and price priority might continue to be valuable. Okay, I've got some other slides, but I basically described our proposal, and I've run out of time. So I'm going to just stop right now and skip to the end. There are a few other issues that we discuss here. But we propose this fully continuous exchange where you trade as a flow, just like a demand or supply schedule from an economics textbook. It makes quantities continuous functions of time and continuous functions of price. And it also implements trading strategies that look like what people want to do, in particular asset management companies. And having worked at asset management companies, it kind of captures the flavor of what's going on in the research and trading environment at these companies today. So I will stop here.
Okay, thank you very much. So. Yeah, let me start with some questions, and then we'll open up the questions to the floor. So let me start with a question to Klaas and Nick first, and then I'll actually ask Pete next. So Pete suggests this theoretical proposal about continuous scaled limit order book. There are, as Pete suggested, there are other ways, so other proposals like this frequent batch auctions, and then there are also random message processing delays. Are you aware of any practical application ongoing right now, any active projects or any debates? Or do you have any suggestion yourself?
Oh, I have many suggestions.
First of all, I mean,
What I would say is that the actual discrete market is going that way. I mean, since the financial crisis, I mean, there has been overcapacity in the industry from the selling side or broker side of things, whereas costs has come down for execution, and I mean the arms race I would say today is with who's got the best algorithm, and a TWAP or VWAP algorithm is almost this, but in a discrete world, as unfortunately the world is, and obviously I mean Fischer Black, who lives in a discrete world, proposes that, but I would say that is already going on to some extent. And in the days of the dark pools, when they were hot, there were quite a few banks who actually offered that you could send in an order for a VWAP trade over the day. So you send in, I want to buy 20,000 shares VWAP over the day, and then at the end of the day, you got what the VWAP was, if someone matched it, of course. But I don't think they're doing that anymore, that I am aware of at least, but that would be quite close to this proposal. Although, mind you, you couldn't slice it up during the day. You just had a full day to do it on. But I think, I mean, it's a fantastic good idea, because the most important thing with your idea that I think you actually mentioned once is that there are no spreads. That's one of the highest costs in trading today, are the spreads. So that's a fantastic thing.
Okay, thank you.
But again, I want to say, who has a more positive view on high-frequency traders than I guess you do, is that there are almost no spreads today at all.
Yes.
I mean, the spreads are very small, and that's primarily due to the high-frequency traders.
Right.
Thanks. So Pete, what's your thought on these comments?
So I agree with Klaus Henrik. If you compare today's markets with the 1980s, you know, NASDAQ dealers might have made an 8 that's 12.5 cents a share. Maybe it was 25, or in some cases 37.5 cents per share on a trade. now that's been reduced to, perhaps a penny, or with maker-taker pricing and some other details, to a fraction of a penny. So if you were to implement our proposal, you're taking something that maybe used to be 25 cents and is now already down to a penny, and you're taking you're getting rid of a good fraction of that last penny. But you can't overstate how much that is. It's kind of a small number compared to what historically you saw. But it adds up to a lot when trading volume is quite high. And I think one of the other technological advantages of our approach is it really does reduce the number of messages that have to go back and forth. So it sort of simplifies the trading process. So you see, it's surprising how much of an economy's bandwidth, information bandwidth, trading in financial assets takes up.
And how much of that information is actually completely useless?
Oh yeah, totally socially useless. And it's been like that for a long time. I was doing some historical research on the crash of 1929. Okay, well, one of the pieces of information that they looked at in the newspaper was how many phone calls were there between the United States and Europe, which was a hugely expensive activity back in the 1920s. And a gigantic fraction of the phone calls between the United States and Europe were quantities and prices for stock trades. So it's always been like that.
Okay, thanks. So actually, let me ask another question to Pete this time.
Okay.
So what are the obstacles of actually implementing this? And then do you think individual investors like myself can be used to this kind of system? I mean, maybe professional investors will kind of maybe get used to that better. Maybe also, the question is, will people get used to this new system? And then is it easy to implement?
Okay, I'll give a quick answer to the question, but then Klaus-Hendrik, you may want to give a longer answer, because you're kind of like the discussant. At a normal conference, you would get to go on for like 15 minutes, so feel free to do so. But I think professional traders can get used to the idea that every big order that they place also has a kind of horizon with it, and think of the order execution as a flow, because they already think like that. But when you look at the mindset of individual investors mindset has historically been based on mistrust. And with some degree of, I think, accuracy, they think their broker is somehow out to cheat them or out to get them, and the fact that they put a bid in at a certain price, and they see the trade execute, see the market execute at that price, and then it's not their order that got executed, but somebody else's order that got executed. That makes traders mistrustful of the way the market works. And so when you're mistrustful, what you want is an instantaneous execution of your order, so the broker doesn't have time to kind of play with it or abuse it, at a price that you can see on the screen, even if you have to pay a penny or two to get that instantaneous nature of the execution. So that's kind of the mindset of individual investors. And this will require a change in mindset. First of all, it makes the price that the individual investors see on the screen a much more accurate indicator of what that individual investor could have executed with their own orders, because everybody's orders get executed at the price you see on the screen. So now suddenly the individual investors can trust what they see. And given that they can trust what they see, they can learn that when you demand instantaneous execution of your order, you pay for that service, that the speed that you're demanding has a price associated with it, and the price drops if you're willing to wait and execute your order gradually. So it'll take some learning, and the learning will involve learning to trust that the market is kind of operating in the interest of the individual investor and not trying to kind of operate against them.
So what's your professional opinion?
I would say, I mean, many times, or correct me if I'm wrong, now more or less all institutional investors send TWAP and VWAP orders and stuff like that to make as little market impact as possible. And also, how would you know that now is the right time to do it? I mean, to send the order. It's just taking the randomness out of the execution, which is a much more sensible way to approach it. I know for myself, when I trade on my interactive broker's account, I default to TWAP. Even though I just send 200 orders on IBM, it's going to be a TWAP. And I know what the time frame is, 20 minutes or something like that, that they default to. I know that of some reason, Sweden, who is a very technology advanced country and very mature when it comes to stock trading, people don't use time spreading algorithms. And I just don't know why. There is some concept that I know now it's the right time, and therefore I feel short if I don't trade at the instant that I make the decision. But I would say that's just making it more random, and probably it's just going to cost you much more than being typically in a maker or taker market where you get paid for actually being passive. So, but that's generally not the market structure in Sweden. So, I think it will take some learning and probably some pedagogic issue from the broker side. But again, I would say that the banks and brokers, at least in Sweden, I would always say to some extent in the US, typically make money from not making the best advice for the client. Because they typically want their clients to trade over the spreads so their internal market makers can sell that to them. And that's obviously not what you're going to get if you do a T or a VWAP order. There are no incentives at the bank for actually promoting that, I would say. So that's a hurdle for that matureness, I would say.
Pete, do you have any more thoughts
I
on
agree.
this?
Please say that I'm wrong.
I agree. No, I agree with you. I think it's
Okay. So actually, I think
said
this
it better than I did.
this opens up, I think, another big question. Having said that, there is this hurdle, institutional hurdle, like incentives, and people are averse against new things. If we introduce this new system, even though that's ultimately a very good one, people might just go to another venue which haven't adopted this new system, no matter whether it's good or bad. So the exchange, which is adopting new system, is ultimately running the risk of losing investors temporarily, at least. So does an exchange, have an incentive to do this? Like when there is a big risk of losing their clients. What was your thought on that?
Should I start?
Yeah.
I think, first of all, you can run it parallel. I mean, you can have different order types. There's no doubt about that. Because that's why I had this question. I mean, the price discovery issue is a big thing because, I mean, from practice, you're not just a researcher, but from practice that anyone is going to send an order in your stock who's cost 41.23. He hasn't got a clue if 21.43 is the right price or not. He's just going to look currently, where is the spread? Oh, I want a little bit cheaper. And he's going to try to buy it from there. I mean, there's no real value of that share. And having that price discovery, I think, is very important. And if you could run parallel systems, so you actually had normal trading with price discovery, then I'm sure you could be running this on a parallel, either on another exchange or an MTF or whatever, or as the different order types. And I see a large value in that. The only thing I was lacking is the price discovery, which must be hard.
Yeah, but I agree with you. You could have these continuous scaled limit orders in your system, and it might be bid at 41.23 and offered at 41.24, and the system would allow you to place a 100 share, 1,000 share, 10,000 share limit order at those penny increments. But you would see that the price is kind of trading in between somewhere. And you would see that it's not trading much. It's trading maybe 1 share per second, so it's taking time. But there's nothing intrinsically contradictory about having that, having both systems operating simultaneously.
Mind you might get a high-frequency trader in there.
You could get a high-frequency trader in there, willing to buy at that bid price, willing to sell at that offer price, and if you want to give up that extra fraction of a penny to the high-frequency trader so that you can, I don't know, finish preparing dinner or finish watching television, because you value your time, and you're willing to pay the high-frequency trader for that immediacy, well, that's fine. And the high-frequency trader is doing a really good service there. They're freeing you up so that you can fix your dinner or watch television.
Okay, thank you very much. So now, let's open up the questions to the floor. Please, raise your hand if you have questions. So do we have a microphone ready? Yeah. Thanks.
Hi, my name is Simon. So I used to be in high frequency trading, but not anymore. So I don't have a dog in the fight. But I was just wondering what you thought. I was just wondering about what you thought about the Crampton, Buddhist Crampton proposal about frequent batch auctions instead, because even though it takes away the high frequency traders, sort of the fact that they have speed, but that's not necessarily the most important thing. A lot of the time is imbalances. If you're going to do that, what they say 10 times per second, which I think is their proposal, that might actually be sort of the greatest gift you can give them, potentially, right? Because it becomes very hard. So if you take just something very practical like the index fund, say, State Street SPY, it would be very difficult with their proposal to implement a simple strategy, whereas today you would just place 500 VWAP orders for some fraction of the outstanding units, and you're done, right? You don't have to think about it anymore. So I was just wondering what you thought about that sort of in terms of unintended consequences from those kind of proposals.
So I think there's some kind of logical issues with their proposal that where I slightly disagree with them, but on the other hand, I actually like their idea, and I've talked to them on a regular basis, and I'm working on a research project with them that's sort of trying to reconcile our two approaches. But two things that I think are interesting issues to deal with in the context of their proposal is they were proposing, clearing the market maybe once per second or once every 100 milliseconds, something like that. There's an issue of like how frequently it would be, and their intuition was that if traders with reasonably good algorithms can cancel orders, let's say in 10 milliseconds, then if the frequent batch auction is held every 100 milliseconds, and the information that makes them want to cancel is arriving in the market randomly, then 90% of the time, they're going to be able to cancel their order. It's only the orders that arrive 10 milliseconds or less before the next auction where they're not going to have enough time to cancel. And some of that, and during some of that information arrives, the high-frequency traders won't have time to pick them off either. So this is a point they made in their paper, that this will, according to the way their paper works, this will reduce a lot of the opportunities that the high-frequency traders have to pick off orders, given the orders that are there. But I think one of the issues that needs to be dealt with is that if you make the batching interval less frequent, traders are going to put bigger orders in. Because if a trader, let's say they had auctions once every second, and you needed to buy 10,000 shares over a three-hour period, well, you need to buy about 1 share per second. So if there's a batch auction every second, you're going to need to have 100 shares execute once every 100 seconds in one of these auctions. And so in the typical auction, on average, you're going to have 1 share sitting there. But if the auctions are held less frequently, say once every 2 seconds, well, now you're going to have 2 shares sitting there. You're going to have twice as many shares sitting there. So yes, you're going to get picked off less frequently. Maybe you're only going to get picked off half as often. But when you do get picked off, you're going to get picked off for twice as many shares. And so this suggests that making their batching interval longer actually matters quite a bit. And making it shorter seems to favor reducing the amount by which you get picked off. But according to their logic, you're then bumping up against the constraint that you don't really have time to cancel your orders. So we think that this logic favors making the batching interval shorter and shorter and shorter. And ultimately, our proposal for continuous orders makes that, it's like having a frequent batch auction every nanosecond or something.
I haven't read their paper. I guess there's also an issue there with the price discovery, because I mean, as you see in the closing auctions on many exchanges, the prices can vary like absolutely crazy.
That's
until
right.
it actually settles down. And I mean, guess you wouldn't want to have that price information because that would disrupt the market.
There's some very interesting issues that arise, but both in their proposal and in ours. One is how you do the close.
Mm-hmm.
You may know this, but back hundreds of years ago in Amsterdam, the way they did the close is they had like a torch burning, and the market closed when the torch burned out. So that's a rather primitive but very effective way of having a random stopping time. So if you were trying to push the market up on the close by buying extremely aggressively on the close, and you would have to buy aggressively for perhaps another 10 minutes or maybe only another 10 seconds. You don't know how many, what the quantity is you'd have to buy. So these kind of issues arise in their proposal and arise in our proposal. Another issue that arises in both proposals that we're thinking about and don't have a solution to yet, but almost do, is what happens when you have multiple assets. You mentioned, I think, a very interesting problem, which is index arbitrage. But to do index arbitrage, you would theoretically have to place hundreds of orders. if you had a frequent batch auction for 1,000 different stocks at the same time, some of them were going to maybe have a surprisingly high price at the auction, others have a surprisingly low price. And then at the end of each auction, everybody's going to recalibrate all of their limit orders and go again maybe 1 second later. But it's not at all clear how index arbitrage works in that situation.
Yeah, I mean, that's actually what we used to do.
Yeah, right.
In the Australian market, where there's a fairly high percentage of volume in the open close, it's not so much in other. And we weren't the only ones. I mean, it was all the high frequency firms were doing it at the time.
Yes.
I mean, which we could hear when we were out sort of drinking, and so it was. That's why I'm saying it. My concern is that if doing it this way might open up that opportunity rather, right?
So you've identified a great research topic. That's what I'm working on right now.
But continuous trading, that must mean continuous trading. One close the market. There's no reason to close it.
You're right. There's no reason to close it, but the markets might
happen
themselves
so
have a
much.
convention that they close it. That everybody just stops trading at 4 o'clock, even if they're allowed to trade afterwards.
Okay, should we move on to the next question? Do you have any? Okay, please.
Should I use the mic?
Yeah, your microphone, please. Yeah.
Thank you. Okay, so I have a question. I mean, trading one stock at a time or two stocks at a time, it will drive a lot of clearing costs. Have you thought about, the post-trade, the cost to actually trade in very small increments? And that is something actually that current traders are trying to avoid, And yeah, that's the first question. I have some more questions.
Okay. Oh, good. Well, that's a great question. So, and I have thought about this, and in clearing and settlement, sometimes there are not only charges per share, but charges per trade. So
that's
if
the
you were going to
standard-
trade one share, it might be
that is the
prohibitively
standard in
expensive.
Europe.
Yeah.
You pay a clearing fee per trade, basically,
Yeah.
which
So-
could be like a Eurocent or so. So
Right.
quite substantial
It's
cost to trade
quite-
a share.
Yeah, so I have thought about this. If you're going to be holding shares in larger units than these, we're proposing prices that are microdollars. That is, we're proposing thousandths of a penny, and we're proposing nano shares, billionths of a share, and we're proposing milliseconds as our units of time. So we think that's practically continuous as far as a human being is concerned. And to deal with the problem that you're raising, we think that the exchanges or the brokers can have kind of book entries for fractional positions, and the fraction could be either a fraction of 1 share or a fraction of 100 shares. But for positions that are deemed to be less than a round lot position, then what would happen would be that your order would just be kind of accumulating a position as a book entry somewhere, maybe at the exchange. And then when it reached the threshold of being big enough to kind of clear or big enough to be recognized as an executed trade for even reporting purposes, which might be 100 shares or might be 1 share, but let's say it's 100 shares, then they would confirm to you 100 shares traded at such and such a price. And if the clearing fee for even that were particularly high, I would favor letting the exchanges then at the end of the day average it all together.
Yeah, central
and just
clearing
say
partner.
10,000 shares, executed at 1 million different prices and 1 million different micro units, but it all averages out to this one price here, and we'll just put one ticket through for clearing and settlement, and they can charge one fee for that particular price quantity pair.
Which of course wouldn't be liked by the European clearinghouses, since they charge in the US. I mean, you have a central clearing where you have just the net at the end of the day you pay for.
Right, but historically there have been kind of ticket charges
Yeah, sure.
in the US as well.
The second question was about, do you think this will drive more trading towards dark pools and in Europe frequent batch auctions, which we call periodic auctions? Basically, traders having size, they happily trade at the midpoint of the spread, in a separate order book
Right.
or separate order books.
So that's another good question. So you could implement our proposal as a dark pool, in the sense that a dark pool operator could say we're taking orders and we're going to take continuous scaled limit orders and we're going to calculate the clearing price within our dark pool, and then we're going to give the traders within the dark pool a price that would be probably at a fraction of a penny between the best bid and the best offer that's quoted in the market. To implement our proposal, not as a dark pool, but as an exchange, I think you would need some relaxation of regulatory rules that require that you quote not only in even pennies, but that you quote, let's say, for 100 shares, and at least changes in the United States. So, you know, the SEC, I think, might have to, I'm not sure, but the SEC might have to say, to allow this particular type of trading, we would need to change the rules a little bit. But I think it could be done as a dark pool, you know, right now.
Yeah, because I mean, lit markets in Europe, you need to follow Texas regime. You need to we have this concept of pre-trade transparency. You need to publish orders,
Right.
unless you have it in the dark pool, or if they are really large, then you can have them as non-displayed. So, I think there are some regulatory issues with the model as
I think
the regulatory landscape looks right now.
Right.
But in a dark pool, yes, could be interesting.
Okay. Some further questions? We can take, I think, a couple more questions.
Hi, I'm Marcus. Very interesting. I really liked the presentation. I have one question regarding, if I understood it correctly. Let's suppose that somebody has submitted a scaled limit order, and then something happens, like some fundamental news comes along, and everybody knows about this, and which would make you want to cancel that order. Wouldn't that make it possible for high-frequency traders who are faster to kind of catch you napping, and in that sense pick you off?
If you really are napping, then you're going to be relying on competition in the marketplace to protect you. So let's suppose that you're buying 10,000 shares at a rate of 1 share per second. It's going to you expect it to take 3 hours, and then you decide to go. Maybe you can squeeze in a round of golf. So you're out there on the golf course, and something happens that makes the price of the stock fall from $50 a share to $40 a share, and you're going to be buying your limit price is going to be buying at 1 share per second, and your limit price is $50. So what's going to happen is the instant that information comes out, high-frequency traders are going to aggressively submit orders to try to pick off your 1 share per second. And it depends on what's going to protect you if you're not going to cancel your own order is competition among the high-frequency traders. And as the high-frequency traders compete, they will push the price from $50 a share down to 40. And as long as they're competitive enough, it will fall from 50 to 40 really fast. It might even fall in like a fraction of a second, in which case you will have lost your $10 per share, but you'll only lost it on a fraction of a share. And so it may only cost you $1 or $2. But when you're not protected is when there's only one high-frequency trader that knows this information. And that one high-frequency trader is going into the market and selling, and maybe at a price that's closer to 50. The other high-frequency traders don't know about it. Then you're going to get picked off. But then you're going to get picked off in the current system too. Everybody's going to get picked off because that single high-frequency trader who knows the information nobody else knows, he's probably going to just capture that profit, not as if he's a high-frequency trader, but as if he's a lower-frequency trader, capturing the profit over a period of time that represents the length of the time it takes other people to figure out what he already knows. And if it takes them an hour to figure out what he already knows, it's not high-frequency trading. It's just kind of front-running figuring out private information earlier than other people. And if it is high-frequency trading, the other high-frequency traders are going to slam the price down to 40 in a fraction of a second, and you're going to be protected.
Okay, great. Thanks.
Do you want to add anything, Lasse?
No, not on that subject. I mean, I think that's kind of well taken care of. And again, I mean, it average out, which is good for any order. So I think it's a very good concept for thinking for anyone to put orders in the market. It's not just to do an at the touch thing, especially these days when the at the touch is so much thinner than it used to be.
Right.
So I think it's very good.
Good. Some more questions? All right. So then I guess we can conclude then we can actually still stay, and then you can have lively discussion afterwards. So if you have anything you want to discuss, please stay and also discuss. And then, thank you very much again for joining us. Especially, thank you very much, Pete, and then thank you very much, Klaus Henrik.
Thank you very much.
So, thank you.
Thank you.